Everybody thought the Microsoft OpenAI deal was invincible, right? A tech giant fused with the golden child of AI. Well, they were dead wrong. The whole thing was a house of cards, built on a spectacular illusion. So today we're performing the autopsy. We're going to find out exactly where the rot started.
It all kicks off with this number, a number you will not find on any public balance sheet. This is the scale of the shadow debt. It's a massive, off-the-books obligation designed to lock these two companies into a financial death spiral.
So that leads us to the big question, doesn't it? Was this whole arrangement a stroke of financial genius? A way to basically print infinite money? Or was it a time bomb, just sitting there, ticking away, waiting to vaporize shareholder value? Let's dig in.
All right, to really get why this all fell apart, you have to first understand the con, and it was a beautiful con. We're about to dissect the flawless financial illusion that had Wall Street absolutely drooling, a perfect circle of digital money that literally conjured record-breaking profits out of thin air.
Okay, so here's how the trick works, and it's almost insultingly simple. Step 1. Microsoft invests billions in OpenAI. But, and this is the key, it's not cash, it's just digital monopoly money. Azure vouchers. Step 2. OpenAI then uses those exact same vouchers to pay rent on Microsoft servers. Step 3. Microsoft turns around and books that voucher rent as real, hard revenue. And the result? Wall Street pops the champagne celebrating this explosive growth that was entirely, 100% manufactured. Genius, right?
Now this is where it gets really, really clever. They weaponized an accounting metric called RPO, or Remaining Performance Obligation. Just think of it like a massive pre-order for cloud services. It's supposed to be guaranteed future revenue, and you know what? Analysts treat it like cash in the bank. So Microsoft's RPO ballooned to a staggering $625 billion, pretty much single-handedly justifying its entire market valuation.
And here it is, the fatal flaw in the whole plan. Look at this. Nearly half, 45% of Microsoft's entire guaranteed future revenue wasn't coming from thousands of stable clients. Nope, it was a promise from a single, deeply unprofitable startup that was burning through cash like there was no tomorrow. I mean, what could possibly go wrong?
So on paper, you have this perfect system. Microsoft prints digital IOUs, OpenAI uses them to pay its rent, Microsoft books it as revenue. It is a flawless, infinite money loop. Until, of course, the pesky laws of physics kick in and those servers actually have to turn on.
And just in case you thought all this clever accounting meant you could somehow escape the entropic decay of the real world, well, you can't.
Now we get to the messy part, the brutal, physical costs. We're talking decaying hardware, melting servers, the real-world entropy that the entire financial house of cards was designed to hide. This is where the bill for all that digital magic comes due, and it's paid in cold, hard cash.
Let's start with the silicon itself. We're looking at an estimated $176 billion in hidden GPU depreciation, just decaying across the tech sector. See, the top AI models make these high-end chips obsolete in about 36 months, but Microsoft's accountants? Oh, they're spreading that cost out over 6 years. They are booking profits today by deliberately ignoring the physical reality of their own decaying hardware. It's not creative accounting, it's a lie.
Next up, water. The data center industry is consuming 449 million gallons of water daily, every single day. That's just to stop the server racks from literally melting down. These hyperscale facilities are draining local water supplies, forcing cities to choose between their own citizens and the insatiable thirst of the AI gold rush. And then you have the operational cost. A single model, Sora, the generative video one, it's estimated to burn through $15 million of hard cash every single day. That's not a rounding error on a spreadsheet. That is a financial furnace incinerating capital at a rate we've never seen before.
So here's the bottom line. There are hard physical limits to this thing. You've got GPUs dying twice as fast as the accounting admits. You've got TSMC, the company that makes 90% of all advanced chips, saying they can't keep up with demand. You have cities literally banning new data centers, and the new cooling systems you need, they're doubling construction costs. You cannot solve these problems by printing more digital vouchers.
So physical costs are spiraling out of control, right? That meant OpenAI's only hope for survival was to maintain these massive profit margins. But, well, the market had other plans. Now we're going to see how competitors turn the AI market from a gold rush into a low-margin knife fight in a phone booth.
The weapon they used, it's something called model distillation. It's actually pretty clever. Instead of spending billions building their own giant models, competitors just paid for API access to OpenAI's best one, hammered it with millions of questions, and then used the answers to train their own smaller, much cheaper versions. It's like stealing the 5-star recipe without ever stepping foot in the kitchen.
And here is the brutal result. OpenAI was charging $1.75 per million tokens, thinking their dominance was untouchable. Then, a Chinese competitor, DeepSeek, hits the market with a distilled model that's just as good for 28 cents. That is an 84% price collapse, and it happened virtually overnight.
And just like that, the premium OpenAI needed to survive was gone. The fat profit margins they were counting on to pay for all that hardware and all that water just evaporated. The entire business model was fundamentally broken.
So now they're cornered. They're bleeding cash, their margins are gone, and OpenAI made a desperate move, a Hail Mary pass that ended up betraying its only real partner and turning what was a financial partnership into an outright hostage situation. Sam Altman, he saw the writing on the wall. He pitched this thing called Project Stargate, a wild $500 billion plan to build his own infrastructure and escape Microsoft's orbit. But Wall Street said no, citing the deficits. Private investors, they wouldn't touch it. And when he went to foreign sovereign wealth funds, the U.S. government stepped in and blocked the deal on national security grounds. Every door slammed shut. OpenAI was trapped.
So, in one final, desperate move, OpenAI secured a $110 billion bailout. But let's be very clear about this. This was not a victory. It was a capture. It was, for all intents and purposes, a hostage situation.
And guess who led that bailout? It wasn't Microsoft. It was Microsoft's biggest cloud rival, Amazon. And to get that cash, OpenAI had to agree to plow huge amounts of money into Amazon Web Services, directly cannibalizing the very Azure revenue that was propping up Microsoft's stock. It's just a beautiful, self-inflicted wound.
And that was it. That was the final domino. With OpenAI now contractually obligated to spend its bailout money with the competition, the infinite money loop was officially and irrevocably broken. So what's the aftermath? The flawless loop is shattered. Microsoft is left holding the bag. They're stuck with billions of dollars in real, physical, rapidly decaying hardware. And meanwhile, their cash-burning, now unemployed tenant has effectively packed up its bags and moved in with the competition across the street. So we're left with this final, brutal truth. Microsoft built a multi-trillion-dollar empire on digital IOUs and some very clever accounting tricks. But now that the illusion is shattered, who do you think gets left with the very real bill for billions of dollars in physical, decaying iron? I think you know the answer.